Hello everyone. Today we are going to continue our discussion of monetary models with sticky prices and wages. The previous two lectures focused on positive analysis, and the job is to describe how the economy works. This lecture, on the other hand, will focus on normative analysis, which is to draw some policy implications based on the new Keynesian models we have discussed in the previous two lectures. This is the final lecture on monetary models with nominal friction, or new Keynesian models. To begin with, we will compare monetary policy implications of different monetary models such as the RBC model, Friedman-Lucas model, and the new Keynesian model. And then we will focus on the new Keynesian model per se. We will ask three policy-related questions. The first one is whether or not you can stabilize the economy using monetary policy in the new Keynesian model. And then we will ask, if you can, should you stabilize the economy using monetary policy in the new Keynesian model? It's actually two different questions. Just like you can kill a person doesn't mean you should kill, right? The last question is, if you can and if you should, how do you implement monetary policy under the new Keynesian assumption? This lecture is closely linked with previous lectures. We have seen how new Keynesian models can explain the business cycles caused by policy shock, demand shock, and supply shock in the previous lecture. All the policy-related questions will be answered based on our understanding of the positive analysis in the previous two lectures, such as can we, should we, and how do we stabilize the economy by monetary policies? Given that the new Keynesian model is actually the mainstream working horse model for most central banks in the world, the argument developed in this lecture is closely linked with the practice of monetary policy in the US, in the Euro area, and in the UK. Now let's try to answer the first question, can we stabilize the economy? This is a summary table I have already shown you in the first lecture in one of the previous lectures, before we have derived the new Keynesian model's conclusions. We will repeat this summary table again here because now we have already derived all the conclusions formally of the new Keynesian models, and this is a good summary of all the models we have covered so far. To facilitate the discussion, I labeled all the models here. Model A is the new classical RBC model augmented with money. Model B is the Friedman-Lucas money surprise model. Model C is the Keynesian coordination failure model. Model D is the new monetarism model, and Model E is the new Keynesian model. To compare different models, the first thing you would like to compare is the key assumption of each model. The new Keynesian model is actually the baseline model of all other models because it assumes a perfect market, while other models like B, C, D, and E simply tries to relax this perfect market assumption and extend the model in different directions. Model B assumes imperfect information between the individuals and the government, which violates the perfect information assumption in a perfect market, while Model C assumes strategic complementarities, which violates the price-taker assumption in a perfect market. So individual decisions are no longer independent of each other. Model D, on the other hand, assumes deficient financial liquidity during crisis periods. The essence of the new monetarism is that special monetary policies should be implemented in special times. And finally, Model E, the new Keynesian models, assumes nominal friction, which violates the perfect competition in the perfect market, because the price can only be fixed or rigid when the firms have the pricing power. The conclusions of different models, of course, depend on these assumptions, but in terms of the money neutrality, only the RBC model generates money neutrality or classical dichotomy. All the other models B, C, D, and E arrive at non-neutrality of money. So the policy implications are of course different. Under the RBC model, since money is neutral, so monetary policy cannot do anything at all. However, for other models in which the monetary policy can do something, the policy implications are also different. For example, in Model B, monetary policies can affect people's decision, but this is done by confusing people and sending distorted market signals. So Friedman and Lucas do not suggest using monetary policies that way. The role of monetary policy, therefore, is limited. Similarly, in Model D, the monetary policy has to be implemented very carefully because if you don't, inappropriate monetary policy may cause an even bigger problem of liquidity. On the contrary, the Keynesian coordination failure model, Model C, and the new Keynesian nominal friction model, Model E, place monetary policy in the center of government tools to stabilize the economy, and they are very optimistic of the government's ability to correctly forecast the economy and correctly implement monetary policy in time. Both models follows the Keynesian tradition and support the government intervention into the economy. However, there are some limitations of monetary policies even for new classical people. We will focus on two important limitations of modern monetary policy practices. First, countries belonging to a common currency area have no autonomous monetary policy, such as in the Eurozone. There is only one central bank for all the countries in the Eurozone, that is the European Central Bank. The monetary policies of all the member countries of the Eurozone are forced to be unified. In normal times, it is okay, but in crisis times, it will cause some problems because countries are hit differently by the crisis and they need different types of monetary policies. For example, countries like Spain and Italy may need more injections of money to save their banks, while countries like Germany and France were doing okay, so expansionary monetary policy would just increase the inflation pressure for those countries. As we know, the Eurozone is dominated by Germany and France, so the monetary policy made in the European Central Bank leaned more towards the needs of Germany and France, while ignoring the need for Greece, Italy, and other countries. Since these countries cannot save their own economy out of the private debt crisis in 2008, the only choice left for them is to use fiscal policies to raise public debt to save the private debt crisis, which led to the public debt crisis in 2009. Another limitation of modern monetary policy is the zero lower bound. The lowest nominal interest rate set by the central bank is usually zero, although some countries, like Japan, do have negative interest rate, but most countries cannot set the interest rate lower than zero. The reason is quite straightforward. If you borrow £100 today and the interest rate is negative, that means you only owe like £90 tomorrow. If I were you, I would just borrow as much as I can so that you can get the maximum out of the bank. This situation is also called the liquidity trap, in which the monetary policy is ineffective because there are already too much liquidity out there. Too much of a good thing is a bad thing. The interest rate for the UK is lower than 1% since the global financial crisis for more than 10 years. We are effectively in a liquidity trap. But note that the traditional monetary policy is implemented by setting the short-term rate of the government debt with lower than 1 year maturity. In the liquidity trap, you can no longer affect those rates. So the central banks thought of a new way to affect the financial markets rates through the medium-term and long-term interest rate of financial assets including those government debts with maturity longer than 1 year, because assets with longer maturity tends to have a higher return, and there are still rooms for these assets to be manipulated by the monetary policy. This non-traditional monetary policy is called quantitative ease. Now let's look at the consequences of the zero lower bound in the formal model. As we know, the interest rate cannot go negative because of the arbitrage opportunity opened by a negative interest rate, because people can simply borrow money from banks and then hold cash. This is effectively short selling. When interest rate hits the zero lower bound, it cannot be lower further to close the output gap in the output market. As shown on the top of the diagram, if zero lower bound is hit, then there will be excess supply in the output market. As assumed in any new Keynesian models, the demand determines the supply. So the actual supply is not equal to the desired supply, determined by the demand. Now let's turn to the money market. When the interest rate is equal to zero, then holding cash is not costly because there is no opportunity cost of holding cash. So the demand for money will be infinite, which means the demand function will be horizontal or perfect elastic. In this case, the money supply will have no effect on the price level or any other variables in this economy. In other words, the monetary policy is no longer effective. This is what we call liquidity trap. Actually, there are two types of liquidity trap. The first type is zero lower bound, as we just mentioned, and there is a second type called financial liquidity, which is actually emphasized by the new monetarism. It is effectively a situation where there are too much liquidity and extra liquidity no longer have any effects. After answering the can we question, now let's turn to the should we question. Of course, the should we question is based on the can we question. It is essentially a question of trade-off between effectiveness and efficiency. There are two traditions of monetary policy. The first tradition comes from the classical and monetarism school of thought. It includes Model A, B, and D in slide 5. They argued for a minimum intervention from the government to implement the monetary policy because government intervention is neither effective, as in the classical school of thought, or efficient, as in the Lucas-Friedman model. On the contrary, the second tradition comes from the Keynes school of thought. Models like C and E in slide 5 argues that stabilization monetary policy can significantly reduce fluctuations because the market is not perfect, and it takes too long for the market to adjust back to the long-run equilibrium, and in the long run we are all dead. So to wrap up, as long as the markets are not perfect due to reasons like coordination failure or nominal frictions, then stabilization policy from the government is useful. But there is a big if here. Monetary policy is only helpful if they are used in time and in the right direction. And that is a big challenge for all the economists working in the central banks. Let's focus on the challenge in the timing of the policies. There are three factors that can induce lags of policy making. The first one is the policymakers do not have complete information. While they do have better information but not complete, they make wrong calls in the history, like in the Great Depression in the 1930s, and they made wrong calls in the financial crisis in 2008. They keep making mistakes. It is not a perfect world, and they are not perfect economists. The second factor is that policymakers have different point of view. As you can see, there are classical school of thought, there are monetarism school of thought, and there are Keynesian school of thought, and they argue against each other as well. So basically, any monetary policy that is implemented in practice is already a reconciliation between different point of views. And as you can see, if there is only one truth, then the reconciled point of view must be wrong. It's like you want to have a heart surgery, and one doctor thinks it should be cut on the left, and the other doctor thinks it should be cut on the right, and you know that one of them is correct, and finally they reconciled with each other, and they cut in the middle. You know that it has to be left or right. Cutting in the middle is definitely wrong. However, that is how democracy works. You reconcile with each other. It is not only time-consuming, but also destined to arrive at a wrong answer. The third factor is that any policies that is implemented now will only have an effect later, and this lagging effect usually takes 6 months to 1 year to be fully absorbed by the economy. However, by then, the economic conditions may have already changed substantially. It is like driving a faulty car. To avoid the obstacle in front of you, you need to be able to do two things. First, you should know where the obstacle is. Second, you have to steer the faulty car in advance, because the faulty car will only react after a while. But in monetary policy implementation, you don't know where the obstacle is, and you can't maneuver the car in advance to avoid the obstacle. And what is worse, there are more than one drivers on the car, and you argue with each other. You get the idea how difficult it is to implement monetary policy in time and in the right way. You can use the global financial crisis as a case study to see the point. As early as 2006, housing market started to decline in the US due to the burst of substandard loans. To be fair, the Federal Reserve reacted very quickly, but only in 2008 they started to cut interest rate to provide extra liquidity required by the banking system. The fiscal policies also followed in 2008 and 2009, as in the two rescue package EESA and ARRA. But bureaucratics takes a long time for all this money to be spent. They didn't happen until 2010. 4 years has passed since the initial housing market problem. Using the faulty car metaphor, it's like you are running into a small obstacle initially, and then you realize it is a problem, and then you maneuver the car to avoid the obstacle. But when you actually do it, and when the car reacted to your maneuver, the initial problem is long gone, and you probably run into a bigger obstacle which you never know. Therefore, no one can guarantee the stabilization policy implemented by central banks can work better than doing nothing. Well, we should have some confidence for our government anyway. So let's see how a typical monetary policy is implemented in a new Keynesian way. In a typical new Keynesian model, there are 3 equations. It is also called the 3-equation new Keynesian model. It is the core of any complicated new Keynesian models with rational expectations and micro-foundation. The first equation is the micro-founded IS equation. It is also the aggregate demand function. It is a relationship between output Y and a nominal interest rate R and expected inflation. This equation is derived from the intertemporal conditions of the representative agent, and this equation is exactly the same as the new classical model. The second equation is the micro-founded Phillips curve, which describes the aggregate supply side or firm's behavior. It describes the relationship between inflation and output and expected inflation under the assumption of sticky prices or nominal friction. The third equation is the Taylor rule, which describes the monetary policy. It is a reaction function of the nominal interest rate R in response to the output and inflation. The Taylor rule is a typical feature of any new Keynesian model to describe how monetary policy is implemented in practice. The original form of the Taylor rule, proposed by Taylor in 1990s, is that the nominal interest rate R is equal to a constant plus 1.2 multiplied by the inflation minus 1.5 multiplied by the output gap Y minus Y star. Y star is the output on the flexible prices and wages, and Y is the actual output. In some variants, this output gap can be replaced by the unemployment rate gap, as you will see in your Year 3 macro module. It means that if the inflation is too high, then interest rates will adjust upward. And if the output gap is too high, the interest rate will be adjusted downward. This is what the monetary policy should be implemented in the normal times, and it is done through the open market operations because the government bonds will be sold or bought to affect the nominal interest rate R. But in the liquidity trap, R is already equal to 0, so you can no longer affect R by the open market operations. Instead, you will use QE to affect other interest rates of the long-term and medium-term assets. This forms the complete plan for the central banks in different times. This figure shows you the historical actual interest rate in black and the predicted Taylor rule interest rate by the blue line. As you can see, during the financial crisis after 2008, the predicted Taylor rule is negative, but obviously in practice you can't do that. So it is not a normal time. Instead, what you do is QE instead of the Taylor rule. Finally, let's compare the fiscal policy and monetary policy response to a recession in the new Keynesian model framework. This diagram shows you the effects of a Taylor rule-like new Keynesian monetary policy response after a recession. Let's assume this economy experiences a negative shock. Price rigidity prevents the output market from clearing. Monetary policy is adjusted to fill the gap, so the nominal interest rate is adjusted downwards from R1 to R2, and the output level is stimulated from Y1 to Y2, and the output market clears. Turning to the money market on the right-hand side. Since interest rate drops and output rises, the money demand will shift to the right. To make sure that the price is fixed as assumed in the new Keynesian model, P1 cannot drop to P2, and money supply has to increase to realize that. To summarize, as a response to the recession, the monetary policy adjusted the interest rate to affect everything in the real side of the economy and the nominal side of the economy, and the drop in interest rate is accompanied by a rise in money supply. What if we would use fiscal policy to respond to this recession? Note that in this case, R, the monetary policy, is now exogenously fixed, and we can only change G, the fiscal policy, in this case. So in the output market, what you can only change is to use a higher G to fill the gap in the output market, while R is fixed by the monetary policy, which we assume is exogenous in the new Keynesian models. G takes effect on the demand side of the output market, so the aggregate demand curve shifts to the right. This is the first round effect because it enters the whole economic system through the AD curve. But there will be a second round effect on the supply side of the economy because a rise in G will induce a rise in tax, which will further affect the budget constraints of the consumer and the labor market, which translates into a right shift of the supply curve on the output market. This is very similar to the previous analysis that output is also stimulated from a lower level Y1 to a higher level Y2, but in this case, interest rate is kept unchanged, but the fiscal policy is the stimulator. Turning to the money market, because Y increases, so the demand for money also shifts to the right. To keep the price level unchanged at P1, And to realize that, just like the previous analysis, we will have to increase the money supply to prevent price drop from P1 to P2. To summarize, if fiscal policy is used to respond to the recession, then the quantities of the output market and the money market are adjusted, leaving the prices and interest rate unchanged. But if you use the monetary policy to intervene, then the interest rate is also changed, which means a distortion of the market signal. And this is what Lucas and Friedman really don't like. This lecture summarizes 3 policy implications related to the new Keynesian models. Can we, should we, and how do we intervene using monetary policies? Some of the contents of this lecture is repeated from the previous lectures. This is intentional because understanding of these economic theories is iteratively spiral rather than simply linear. And I hope this repetition and summary can help you to understand the links and differences between different schools of thought in business cycle and monetary policy. Have fun!